Okay, I want you to stop and think for just a second. What's the biggest, most critical piece of infrastructure in crypto that, honestly, most people probably don't even see?
Yeah, it's not flashy.
Not at all. We're not talking about the newest layer one or some hot NFT drop. We're talking about the bedrock,
Hmm.
the foundation that makes DeFi, insurance, gaming, pretty much any complex Web3 operation actually work.
Hmm.
And imagine this, right? If that foundation suddenly failed, or even worse, if it fed bad data, deliberately bad data, for just a moment,
Billions gone. Instantly.
billions of dollars in secured value, just poof, at risk. That's the kind of systemic importance we're digging into today.
Exactly.
So today we are doing a deep dive into Chainlink. And our mission is pretty clear. We've got this stack of sources covering everything from, the core mechanics, the tokenomics, to these huge partnerships, Google, Swift.
The big league.
Absolutely. And we want to basically shortcut your learning curve, give you a really fast, thorough understanding of why this tech has earned that title, the trust layer of Web3.
And look, that trust layer thing, it's not just marketing hype. It's actually a technical description of what it does. Chainlink is one of those projects you really have to understand, not just as an asset, but as this essential middleware for the globe, really, if you want to get where tokenized finance and the whole digital economy are actually heading.
Right.
So we've pulled together specific case studies, some key analytical ideas, like what's the difference between demand for the utility versus demand for security collateral?
Yeah.
And metrics, real metrics like total value secured that keep us grounded in, infrastructure analysis, not just hype.
Okay. But before we dive really deep into how Chainlink is powering, well, everything, let's touch on something the sources actually brought up, the importance of supporting this kind of foundational work itself.
Yeah, exactly. It's a good parallel. Just like Chainlink needs its node operators, its stakers to keep the network secure and the data flowing accurately. Well, we rely on foundational support too.
Yeah.
The sources actually mention, engaging with content like this, liking, subscribing, maybe commenting, hitting that notification bell. It genuinely helps us out. It boosts visibility, helps the channel grow, and basically lets us keep dedicating the time to bring you these kinds of deep quality insights into crypto.
It really is that essential feedback loop, isn't it? If you find value in the analysis, in the knowledge we're sharing, that engagement is kind of the fuel. It lets us justify putting in the hours and resources to maintain this quality. It's a concept that tracks perfectly with the infrastructure we're about to discuss.
It really does connect directly. I mean, think about Chainlink's economic model for a second. You're financially incentivized through staking to support the network because the quality of the output, the data feeds, depends on that support.
Right.
Here, maybe it's not direct finance, but you're incentivized to support the platform through engagement because the quality of the insights we can provide depends on having that visibility, that audience. Good infrastructure, whether it's data or information, always needs that foundational backing to really thrive.
That's a perfect parallel. Okay, so with that said, let's unpack this core utility. Let's get into the weeds on the technical need that Chainlink fills. All right, let's start with the basic definition, but let's move fast. Chainlink, decentralized Oracle network. Now, for our listeners, the key takeaway isn't just Oracle, it's the decentralized part, and the fact that it's become the dominant one.
Absolutely. Its whole purpose is connecting these secure, closed-off blockchains with the real world, with that off-chain data that actually dictates value and events happening outside the chain.
And why is that bridge so critical?
Well, it's paramount. And it's not just simple price feeds anymore, although those are vital. The kinds of data are getting way more diverse, more complex. Yes, you have the crypto price feeds underpinning basically all of DeFi.
The classic use case.
It's the classic. But now Chainlink also handles proofs of reserve crucial for stablecoins, for CEX transparency. It handles weather data, think parametric insurance, verified payment confirmations for things like escrow, and increasingly computation results like verifiable randomness functions, VRFs used in high-stakes gaming, NFT mints. It's expanding constantly.
Which leads us right to the core problem Chainlink solves.
Yeah.
This closed system issue. Why can't a smart contract on Ethereum just, ping an API on the web and get the ETH price?
Yeah, it seems simple, but the answer is deep in the blockchain design philosophy. They are fundamentally deterministic systems, meaning they're built to be closed, secure, immutable, because every single node running the exact same code has to arrive at the exact same result based only on data already inside the ledger.
Okay.
If a smart contract tried to call out to, say, CoinMarketCap, well, that external data could change millisecond to millisecond, or the server could just go down. Different nodes would get different answers or no answer.
And that breaks consensus. If nodes disagree, the whole chain grinds to a halt. Fatal.
Exactly. That non-determinism would shatter the core security model. Blockchains get their security because they're isolated, like a vault. But if you want that vault to do complex, real-world stuff, like a loan needing liquidation based on asset prices, it needs outside data.
So the very thing that makes them secure also limits them.
Precisely. This intentional security limitation makes complex finance, insurance, whatever, simply impossible without a way to securely import that external data.
And the obvious but wrong solution is a single centralized data feed.
Right. You could do that, but you've just recreated the exact single point of failure the blockchain was designed to eliminate. Suddenly, your $10 billion DeFi protocol depends entirely on the uptime and honesty of one server somewhere. That's just not acceptable risk.
Which is where Chainlink comes in as the secure, trust-minimized bridge. It doesn't just shuttle data, it brings verifiable truth onto the chain.
That's the key. Verifiable truth. By providing this decentralized mechanism, it enables the core functions of basically all major dApps. We talk about layer ones as settlement layers. Chainlink is arguably the enabling layer for secure automation on top of those chains.
Okay, so let's talk about the fuel for this enabling layer. The native token, LANK. It's not just for speculation, right? It's a critical piece of the machine.
Absolutely critical. It has this dual function that's pretty sophisticated compared to a lot of tokens. First, yeah, it's the basic utility token. Node operators, the ones doing the work, running servers, getting data, they get paid in Link. So more Chainlink usage directly means more demand for Link to pay those fees.
Makes sense.
But second, and this is where the security model really shines, it's used as security collateral through staking and increasingly governance.
Let's unpack that security function right away, because that feels like the core differentiator.
It absolutely is. Node operators, and now community stakers too, have to lock up significant amounts of Link. This isn't just parked money. It acts as a bond, a guarantee.
Like putting skin in the game.
Exactly. If an operator gets caught being malicious, maybe submitting a clearly wrong price to try and trigger bad liquidations, their staked LNK can be automatically confiscated or slashed. This financial incentive structure is built around minimizing trust. It makes the cost of trying to cheat the system way higher than any potential profit you could gain.
Okay, let's dig into those mechanics a bit more. Saying it's decentralized is fine, but our listeners get that. What are the specific, maybe proprietary mechanisms Chainlink uses to make sure the data isn't just accurate, but secure against really sophisticated attacks?
Right. The key is what they often call their data aggregation process. When a smart contract requests data, let's stick with the Bitcoin price example, it doesn't just ask one node.
No single point of failure.
Correct. The request goes out to a whole network of independent node operators. Each one of those operators then pulls data from multiple different high-quality sources exchanges, professional data aggregators. Then they submit their individual answer back to the Chainlink network.
So it's redundancy layered on redundancy. Multiple nodes, each checking multiple sources.
Precisely. And the final price that actually gets written onto the blockchain isn't just a simple average. It's a more sophisticated, often source-weighted medianization of all those inputs.
Meaning outliers get ignored.
Exactly. If one data source is way off or looks like an attempt to manipulate the price, the aggregation contract automatically filters it out. It's this decentralized consensus at the oracle level that ensures accuracy and makes the system incredibly resistant to attacks targeting any single data provider or even a single node operator.
And if you eliminate that single point of failure, you eliminate the main attack vector. That level of redundancy is just paramount when you're talking about securing billions, right? That's the economic moat.
And the staking mechanism basically cements that moat, makes it deeper. When they introduced staking, it was specifically designed to increase the network's economic security, what we call crypto economic guarantees.
How so?
By forcing operators to post significant collateral, actual in-ink staked, Chainlink creates a powerful financial deterrent. Think about it. To successfully corrupt a price feed, even for a short time, maybe long enough for a flash loan attack, you'd theoretically need to acquire and stake more Link than the profit you could possibly make from the attack.
Because you know your stake is gone if you get caught.
Right. All that collateral will be slashed. It aligns incentives beautifully. The network safety is directly tied to the financial well-being of the token holders and operators securing it.
And that successful alignment, that's what elevates this beyond just being, crypto plumbing. It makes it a real security foundation.
Which brings us right back to that powerful analogy from our sources.
Mhm.
Chainlink isn't just infrastructure. It's effectively the trust layer for Web3. It's providing that underlying guarantee of reliable data.
So when we say trust layer, what does that really imply? It sounds like systemic security. It means every major protocol, whether it's DeFi or a big bank experimenting with tokenization or some blockchain insurance policy, they're all basically delegating trust for external data to Chainlink's decentralized consensus.
It implies a massive critical responsibility, that total value secured, the TVS, that relies on Chainlink feeds. It can easily run into the hundreds of billions of dollars. If Chainlink is the mechanism providing the shared, verified reality that all these dApps depend on, well, its importance just scales exponentially as the whole industry matures. It's like the invisible security guard for all these applications,
Yeah.
making sure the inputs are sound.
That structural position seems incredibly strong. It's not really competing directly with the layer 1 blockchains.
No, it's partnering with them. It's providing a critical service that, as we discussed, none of them can securely provide themselves because of their core design.
So its success isn't tied to just one chain winning out.
Exactly. Its fate is tied to the success of the entire multi-chain ecosystem and the fundamental need for reliable external data across all of them.
Okay, this is where it gets really interesting, I think. Looking at how this trust layer is being adopted, not just by the crypto natives anymore, but by the traditional financial world.
Yeah.
Yeah, we absolutely have to detail Chainlink's foundational role in DeFi first, because that's really where it proved itself and got escape velocity. Our sources list the big names: Avive, Synthetics, Compound.
So pillars of DeFi.
Right. These represent tens of billions in market cap, huge amounts of locked value, and they are all fundamentally critically dependent on Chainlink price feeds.
Let's use AB as that perfect technical case study. It's a lending and borrowing platform, right? Over-collateralized. So a user puts in, say, $150 worth of Bitcoin as collateral to borrow $100 worth of a stablecoin.
Standard DeFi loan structure.
Standard. But the protocol needs to watch the value of that Bitcoin collateral like a hawk constantly. If Bitcoin's price drops and the collateral is suddenly only worth, say, $110,
The loan's underwater, or close to it. It needs to be liquidated before the platform itself loses money.
exactly. And the smart contract has to execute that liquidation based on a precise, reliable, near real-time price feed. If that feed lags or if someone manipulates it, the whole system could break down. Insolvency looms.
And a single centralized API feed for that price. That's just asking for trouble.
Totally. It could be bribed, it could be hacked, it could suffer a denial of service attack right when a bad actor wants to force liquidations or make a dodgy trade. Chainlink provides hundreds of these decentralized price feeds. They update frequently, every few minutes, or even faster if the market gets volatile. It gives Avive the assurance it needs to manage its risks safely.
So for Aave, Chainlink's reliability isn't just a nice feature, it's core operational necessity.
Absolutely. Couldn't run without it or something very much like it.
Now, this necessity gets even deeper when we think about the multi-chain world we live in. All this DeFi activity is fragmented across different blockchains. Ethereum, Arbitrum, Avalanche, Solana. How does Chainlink help bridge these silos? How does it let assets and data move securely between them?
Okay, that brings us to the Chainlink Cross-Chain Interoperability Protocol, CCIP. This is arguably the most strategic piece of Chainlink's infrastructure right now,
Why is that?
because its goal is to be the single secure standard for sending messages, moving tokens, and sharing data between any connected blockchain, no matter their underlying architecture. Think of it as a universal translator and secure transporter for the blockchain world.
Before CCIP, wasn't cross-chain bridging kind of notoriously risky? We saw so many huge hacks.
Infamously fragile, yeah. Bridges were, and often still are, a major weak point. Multi-million-dollar exploits targeting centralized bridge operators or bridges with poor security design were common. CCIP is designed specifically to fix that fundamental security vulnerability.
How does it achieve better security?
Well, it leverages two main things that older bridges often lacked. First, it uses the same massive, battle-tested, decentralized network of Chainlink node operators for validating the cross-chain messages. So you have that existing security layer.
Okay.
Second, and this is really crucial, it integrates a separate independent network called the Risk Management Network, or RMS.
What does that do?
The RMS is made up of highly secure, independent entities, could be other protocols, security firms whose only job is to constantly monitor the CCRP service. They look for any suspicious activity, weird transaction patterns, potential violations of the rules before the transaction gets finalized on the destination chain.
So it's like an extra dedicated security audit layer running in real time. A safety net specifically for cross-chain stuff.
Exactly. A cryptographically enforced safety net designed to prevent those catastrophic bridge failures we saw so much of. And that level of verifiable layered security is what starts getting the attention of the big institutional players, the ones with massive compliance departments and zero tolerance for risk.
Right. Because secure cross-chain movement plus the verifiable data integrity we talked about earlier, that's the prerequisite for banks and traditional finance to even consider using public blockchains or tokenized assets seriously.
Precisely. And this is where we see that huge leap towards institutional adoption really taking off.
Let's nail down those big institutional endorsements. Google Cloud back in 2021, that was an early signal, right? What was the significance there?
Yeah, that partnership was really about validating Chainlink's data integrity for enterprise use. Google's BigQuery is this massive data analytics platform. Integrating Chainlink meant Google Cloud customers could pull in and use real-world verified blockchain data alongside their traditional data. It proved Chainlink wasn't just for DeFi, it was reliable enough for complex, large-scale enterprise data jobs.
Okay, interesting. But the real game changer, the one that made everyone sit up, was Swift and major global banks starting to adopt CCIP beginning around 2023. That feels transformative. Swift moves trillions daily, connects practically every bank. What are they using CCIP for?
It's massive. The core use case is bridging the old world traditional finance infrastructure with this new world of tokenized assets. Swift is piloting CCIP to allow secure communication between their existing ubiquitous messaging system and various blockchain networks, both public and private.
So give me an example.
Imagine a major bank wants to transfer a tokenized bond from its own internal private blockchain ledger over to Ethereum to trade it in a DeFi liquidity pool. But they want to initiate and manage that transfer using the Swift systems their staff already know and trust. CCIP acts as the secure middleware that translates and transmits those instructions between the Swift network and the blockchain.
Wow. Okay, that's not just an endorsement. That's basically institutional recognition that Chainlink is becoming necessary. Systemic plumbing for the future of finance. It catapults Chainlink way beyond just being a crypto project.
Absolutely. I mean, when the organization that handles the world's money flows decides to use your protocol to explore how banks will interact with blockchains in the future, it fundamentally validates Chainlink as vital global infrastructure, not just some niche Web3 tool.
So we have to ask you, the listener, how does this kind of integration with giants like Swift fundamentally change how you perceive Chainlink's long-term staying power? It suggests its future isn't just tied to the ups and downs of DeFi speculation anymore, right? It's tied to this potentially much slower but vastly larger shift of global finance onto tokenized rails. That's a whole different ballgame.
And that shift in the total addressable market is absolutely key when you think about the investor perspective. So let's transition smoothly into the token economics, because this extreme utility is what really drives the value proposition for the Link token itself. As we said, Link serves both masters, utility for payments, and collateral plus governance for security.
Right, and the investment thesis seems to heavily rely on this sort of flywheel effect, doesn't it? More protocols, more chains, more big institutions using Chainlink oracles or CCIP. That puts pressure on the Link token from two directions at once.
Exactly. Two simultaneous pressures. First, pretty straightforward, increased transactional demand. You need Link to pay those node operators for their services. More usage equals more fees paid in Link.
Okay, that's the utility side. What's the second pressure?
The second is increased security demand. And this is the really crucial distinction, I think. As the total value secured TVS running through Chainlink feeds goes up as more billions and eventually trillions rely on its data, the amount of Link that must be locked up as collateral, staked, to adequately secure that value has to rise proportionally.
Ah, right. You need a bigger economic deterrent to secure $100 billion than you needed for $10 billion. Makes sense.
Precisely. So you've got this rising demand for the token just to use the network, bumping up against a structurally shrinking available supply because more and more Link is being locked away for staking to provide that essential security.
That creates a pretty powerful self-reinforcing economic loop.
It really does. You could almost compare the utility model to a successful Web2 software as a service, a SaaS model, but with these cryptographic guarantees built in. Protocols are essentially paying a secure subscription fee in Link to get access to this high-quality, reliable, decentralized data stream. And as the network scales, the cost of just acquiring the link needed for staking and paying those fees drives demand, almost irrespective of the broader crypto market sentiment sometimes.
And that introduction of staking, it has another effect too, right? Beyond just security.
Yeah, it directly impacts the circulating supply. By locking up a significant portion of the token supply, it reduces the amount freely available on the market. And perhaps more importantly, it directly ties the token's economic health to the network's actual success and security. The long-term holders, the stakers, they are literally the ones securing the network, and they are financially penalized if that system fails. Their interests are aligned with the network's integrity.
So if we zoom out then, the long-term investment thesis looked incredibly compelling. You're basically betting that global blockchain adoption, driven by Web3, sure, but also institutional tokenization, real-world assets, RWAs, massive gaming economies, that this adoption is inevitable.
Which seems like a pretty safe bet at this point.
And every single one of those sectors needs secure external data. So the demand for Oracle services isn't just growing, it's set to explode. And Chainlink is sitting there as the dominant, deeply entrenched infrastructure provider for that service.
You're essentially investing in the concept of trust infrastructure itself. If Chainlink truly is the trust layer, its value should scale, maybe even non-linearly, with the total value being secured across all the blockchains it serves. It becomes this chain-agnostic, yet absolutely ecosystem-critical piece of middleware.
That really does sound like the definition of a potential long-term blue-chip infrastructure play in the digital asset space. You're not just betting on one application winning or one layer one. You're betting on the fundamental, persistent need for verifiable truth in this increasingly digital, decentralized world.
It's pretty rare, actually, to see a piece of infrastructure dominate its specific niche so thoroughly and then transition so effectively into being adopted by traditional financial giants. It feels a bit like watching Cisco emerge back in the early days of the internet, but maybe compressed into 5 years instead of 20.
That context really puts the Lang token's role into perspective. Its value isn't just speculative, it's derived directly from its systemic necessity. Okay, so for you, the listener, who wants to go out and actually verify this thesis, dig into the data yourself. Our sources highlighted some crucial metrics, things that move us beyond just the narrative and into hard evidence. We can use on-chain data to confirm this adoption story, right?
Absolutely. Let's start with just basic adoption metrics. The most obvious one is just the sheer number of integrations. The sources mention thousands of projects using Chainlink oracles as of 2025. That's not just a vanity metric, it shows a powerful network effect.
How so?
Well, every new protocol that chooses Chainlink makes it an easier, safer choice for the next protocol. It reinforces Chainlink as the industry standard. You also want to track things like the growth in the number of active node operators and maybe where they're located geographically. That shows the decentralization and redundancy on the supply side is growing too.
But as you mentioned earlier, the real killer metric, the measure of just how critical Chainlink is, has to be total value secured. TVS, explain that again.
Right. TVS represents the actual dollar value of the capital, the collateral in lending markets, the assets locked in derivatives, the value of tokenized assets that is directly dependent on Chainlink's data feeds for its security and correct operation.
So TVS is basically a financial measure of how much trust the market puts in Chainlink.
Essentially, yes. When that number is in the tens or even hundreds of billions of dollars, it's a massive signal. It shows that the financial markets, both the DeFi natives and now increasingly the institutional players, have extremely high confidence in Chainlink's decentralized consensus. A high and ideally rising TVS is probably the single most powerful indicator of Chainlink's systemic importance and proof that it's truly functioning as that trust layer.
And we can connect these hard metrics back to the price history of the LNK token itself. The timeline tells a really interesting story about different phases of adoption, doesn't it? Compare the growth back in DeFi summer 2020.
Right, when protocols like Arave and Compound just exploded onto the scene.
Compare that growth spurt to the growth we've seen following the launch and wider adoption of CCIP starting around 2023.
It's a fascinating comparison. That 2020 growth, that was almost pure crypto-native utility driving it. Chainlink solved the immediate burning problem of getting reliable price feeds onto Ethereum for this new DeFi ecosystem. It was rapid, explosive growth, but also very tightly coupled to the volatility and sentiment within the DeFi market itself.
Okay.
The growth phase starting around 2023, however, that signals a real paradigm shift. This phase is driven much more by institutional interest, by the need for interoperability solved by CCIP, by the move towards tokenizing real-world assets. These drivers open up entirely new, absolutely massive markets far beyond the typical crypto user base.
So the later phase suggests a potentially far more fundamental, maybe more sustainable demand driver for Link. It's the difference between relying on crypto speculation versus relying on the plumbing needed by global finance.
Exactly. That transition is critical for how you analyze the token now. The key question is shifting from how's DeFi doing this week to something more like how quickly are global assets actually being tokenized and how much value is Chainlink being trusted to secure within those new systems.
And finally, we have to re-emphasize that sheer dependency within DeFi itself. What percentage of major DeFi collateral relies on Chainlink?
It's vast. Overwhelmingly, the major lending markets, the synthetic asset platforms, the decentralized derivatives exchanges, they all use Chainlink price feeds. It's become the systemic engine providing those verified inputs needed to prevent manipulation and keep the markets functioning. That level of dependency just underscores how foundational, almost irreplaceable, it is to the health of the entire decentralized financial economy right now. Hashtag outro. So wrapping this all up, what does this deep dive really tell us? Chainlink's journey is pretty unique in the space. It started out solving a very specific, quite niche technical challenge, that determinism problem on blockchains, and it managed to successfully evolve into this absolutely essential foundational infrastructure layer. It's relied on by the biggest DeFi protocols, yes, but now also, critically, by traditional finance giants like Swift. It really has become the invisible backbone for secure automation in Web3.
It provides that security layer, that trust, that allows smart contracts to actually interact safely with real-world data. And, maybe just as importantly, it allows institutions to start trusting smart contracts. It gives these decentralized applications the eyes and ears they need to function safely by feeding them accurate, verified reality.
And that position, that centrality, leads us to a really crucial, provocative, final thought for you to chew on, pulled straight from the sources we looked at. Given the hundreds of billions in value Chainlink now secures, given its deep inroads with institutions, we really have to ask, do you fundamentally see Chainlink as a long-term, deeply entrenched blue-chip infrastructure play? Or is it still in your mind viewed primarily through the lens of being a speculative DeFi token?
Yeah, considering its utility is now becoming essential for things like global banking interoperability, for securing TVS across basically every major chain, its value proposition feels like it's matured far beyond just riding the waves of crypto speculation. So the ultimate question, maybe for your own research, is this. If, theoretically, the world's assets do eventually get tokenized, and the verified truth needed to manage those assets, to trade them, to secure them, is routed through this decentralized network, what is the true ultimate scale of Chainlink's importance? Just mull over that level of dependency. Thank you for joining us on this deep dive into Chainlink. We really appreciate you engaging with the content, supporting the work that goes into bringing you these insights. We'll catch you on the next one.